In our last video, we covered the basics. An option gives you the right to buy or sell an asset at a set price before a deadline. Today, we are going one level deeper to see how those mechanics actually operate under the hood of the real market. It is a common misconception that companies like Apple sit around printing their own stock options ahead of time. They don't. The exchanges don't print them either. Think of it like a poker table. A contract doesn't exist until a buyer and a seller sit down and agree to a trade. The moment you buy an option that didn't exist before, you and the seller just created it together on the spot. These agreements take place on regulated exchanges, places like the Chicago Board Options Exchange or the Philly Stock Exchange. But the heavy lifting is handled by the OCC, the Options Clearing Corporation, which steps in to act as the ultimate referee. The OCC guarantees every single trade. If the person who sold you a contract goes broke or tries to back out, the OCC ensures you still get paid. This completely eliminates counterparty risk from the market. To see how this works in practice, let's look at the four main players. First, there's you, the retail trader. You're the individual placing an order through a brokerage app. Then you have institutional traders, hedge funds, mutual funds, and banks. They trade in massive sizes, hedging billions of dollars and driving the vast majority of market volume. The liquidity they rely on comes from market makers. These are large financial firms operating around the clock, willing to buy and sell at any given second to ensure you can always enter or exit a trade. Finally, there's your broker. They act as the struct intermediary, taking your request and routing it out to the wider market. Let's track a single trade from start to finish. Say you open your app and tap buy on a single Apple call option expiring in 30 days. Instantly, your broker blasts that order out across multiple exchanges, scanning the market for the best possible price. A market maker's algorithm sees your order and agrees to take the other side, selling you that contract and adopting a short position. Right down the middle steps the OCC, legally separating you and the market maker while securing the cash premium from your account. This entire relay race happens in milliseconds. A simple tap on a smartphone screen instantly results in a legally binding, globally secured financial contract. Before you can tap buy, you have to navigate the options chain. Think of this grid as the restaurant menu for a specific stock. It displays every single contract available, organized by the strike prices running down the middle. On this menu, you will see two very specific columns: the bid, which is the highest price a buyer is currently willing to pay, and the ask, which is the lowest price a seller will accept. The gap between them is called the spread. It works exactly like a currency exchange booth at an airport. That gap is the middleman's built-in profit margin. Because that spread can be extremely wide on less liquid stocks, there is a strict rule of thumb for trading options. Always use limit orders. A limit order lets you specify your exact price, whereas a market order just accepts whatever is currently available. If you throw a market order at a severely wide spread, you can instantly lose 20 to 40% of your investment directly to the market maker before the stock even moves. So what actually dictates the prices on that menu? It comes down to three main pillars: how close the stock price is to your strike price, how much time is left until expiration, and implied volatility, which measures the market's expectation of future price swings. Those three pillars combine into a final price tag made of two distinct halves. You have intrinsic value, the actual built-in worth of the option right now, and time value, which represents the potential for the stock to move in your favor later. But time value constantly erodes. As the deadline approaches, if the underlying stock doesn't move, time actively drains the value of your contract. You do not have to wait for the sand to run out on expiration day. You can close your position early by executing the exact opposite of your opening trade, like selling to close a call option you previously bought. Professionals do this consistently. A common rule is to close out early to lock in 50% profits, cut positions before losses compound, or free up trade capital. The options market operates as a calculated mathematical engine. By understanding its moving parts, you have the ability to control your exits and manage your risk. But the ultimate question remains: how do you make money with options?